In 1720, a single company nearly sank the British Empire. The year is 1720. London, a burgeoning global capital, was gripped by an unprecedented frenzy, not of war or plague, but of speculation. A company, chartered for trade and the management of national debt, promised unimaginable riches, and the public from pauper to peer was desperate to claim a piece. This was the South Sea Company, an entity born from the ambitious, often desperate, need to manage Britain's colossal national debt. Their solution involved a grand bargain, a financial alchemy that would ultimately lead to Britain's first great financial mania. The company's origins trace back to 1711, a time when Britain was embroiled in the War of the Spanish Succession. The war was expensive, leaving the government deeply indebted. A bold plan emerged to consolidate much of this public debt, converting it into shares of a new trading company. In exchange for taking on a significant portion of this debt, the South Sea Company was granted a monopoly on trade with Spanish South America. The very name, South Sea, conjured images of gold mines, exotic goods, and boundless wealth, despite the grim reality of Spanish colonial control. The reality was starkly different from the dream. Spain maintained strict control over its colonies, and the actual trade permitted to the South Sea Company was minimal, often limited to a single annual ship. The promised riches were largely theoretical, a mirage shimmering on the horizon. But the company's true value wasn't in its trade. It was in its innovative, yet fundamentally flawed financial structure. The company offered bondholders shares in the South Sea Company in exchange for their government annuities, promising a fixed, attractive return. This mechanism, designed to reduce the national debt, became the engine of speculation. As more government debt was converted, the company's stock price began to climb, fueled by both genuine interest and deliberate manipulation by company directors. By 1719, the South Sea Company proposed an even grander scheme: to absorb virtually the entire national debt, some £31 million. This audacious proposal was met with fierce political opposition, but the company's directors, through shrewd lobbying and outright bribery, pushed it through Parliament. Sir Robert Walpole, a prominent Whig politician, stood as a lone voice of caution, warning of the speculative bubble forming. His warnings were largely ignored, drowned out by the chorus of greed and the promise of immediate wealth. The spring of 1720 saw the South Sea bubble inflate dramatically. The company's stock, which had been around £128 in January, soared to over £1,000 by July. Everyone, it seemed, wanted a piece of the action. The euphoria was infectious. People mortgaged homes, sold estates, and invested their life savings, convinced that the price would only continue its ascent. The allure of quick, easy money proved irresistible, blinding many to the underlying lack of real value. This period spawned a host of other speculative ventures, known as bubble companies. These ranged from the absurd, like a company for carrying on an undertaking of great advantage, but nobody to know what it is, to more plausible but equally unsound ventures. The South Sea Company, ironically, became a victim of its own success. Fearing competition, it lobbied for the Bubble Act in June 1720, which prohibited the formation of joint stock companies without a royal charter. This was intended to suppress rival bubbles, but the act had an unintended consequence. It burst the smaller bubbles, and the capital that had flowed into them now rushed back into the perceived safety of the South Sea Company, pushing its price to unsustainable heights. The peak was short-lived. By late July, cracks began to show. Savvy investors, including some company directors, started selling their shares, quietly taking their enormous profits. The whispers of doubt grew louder. The panic truly set in by August. As more people tried to sell, the price plummeted. By September, the stock had crashed from over £1,000 to below 200. Fortunes were wiped out overnight. The aftermath was catastrophic. Thousands of families were ruined. Merchants, nobles, and even members of Parliament lost everything. The trust in financial institutions, and indeed in the government, was severely shaken. The political fallout was immense. Public outrage demanded accountability. A parliamentary inquiry was launched, revealing widespread corruption, bribery, and fraud involving prominent politicians and company directors. Several directors were arrested, their estates confiscated. Even the Chancellor of the Exchequer, John Aislabie, was implicated and forced to resign. It was a scandal that reached the highest echelons of British society. Sir Robert Walpole, the man who had warned of the bubble, emerged as the political savior. He skillfully navigated the crisis, restoring public confidence and stabilizing the economy. His actions cemented his position as the de facto first Prime Minister of Britain. Walpole implemented measures to rebuild trust, including a scheme to redistribute some of the confiscated assets to the victims. The South Sea Company itself continued to exist, albeit in a diminished role, until its eventual dissolution in the 19th century. The South Sea bubble left an indelible mark on financial history. It highlighted the dangers of unchecked speculation, the seductive power of quick wealth, and the devastating consequences of corporate and political corruption. Its lessons resonated through centuries, influencing regulations and shaping our understanding of market dynamics, reminding us that even the most ambitious schemes can unravel with devastating speed when detached from fundamental value. The human elements, greed, fear, ambition, remain constant, making the South Sea bubble a timeless cautionary tale in the annals of financial folly and corporate downfall. Explore how another grand vision ended in collapse by watching our deep dive into the Enron scandal next.